Bangkok, 1997. You run a small electronics shop in a crowded market district. Glass cabinets packed with cables, processors, circuit boards. Most of your inventory comes from overseas suppliers, and every few weeks you wire money through your local bank to keep the shelves full. If the parts stop arriving, the store stops earning. This time, the invoice is $18,000. Normally, the math is simple. For years, the Thai baht has sat comfortably around 25 baht per dollar, steady enough that no one in the market even checks the rate anymore. The peg feels permanent, like a ruler fixed to the wall. Your bank confirms the transfer, routine paperwork. Another ordinary payment moving through a system everyone trusts. But this time the transfer doesn't clear. The bank asks you to wait. One day passes, then another. Meanwhile, the supplier sends a reminder. The shipment won't leave the warehouse until payment arrives. When the updated invoice finally appears, the numbers feel wrong. The same order now costs 30 to 40% more in baht. Nothing about the parts has changed, only the currency. The government still says the baht is stable, but the rate your bank is quoting no longer matches the promise. And once that happens, something important has already broken, because currency collapses rarely arrive as a single shock. They follow a sequence, and once that sequence begins, the countdown has already started. If moments like that make you uneasy, subscribe, because the systems that look strongest are often already under pressure. To understand why that small payment suddenly felt wrong, we need to look at the hinge holding the entire system together. In Thailand, during the 1990s, that hinge was a currency peg. The Thai baht was held close to 25 baht per dollar, year after year, steady enough that people stopped questioning it. Shop owners priced goods around it. Banks structured loans around it. Foreign investors treated it like a permanent anchor. It didn't feel like policy. It felt like gravity. But a fixed exchange rate survives on something far less permanent. Behind the promise sits a shield, the central bank's foreign reserves. Every time dollars leave the country, that shield has to absorb the pressure. Every defense draws from the same vault, and the shield is not infinite. For years, two powerful forces quietly leaned against it. Companies borrowed heavily in dollars because the exchange rate looked safe. Investors poured capital into the country because they believed the peg could not move. During the boom, those forces made the system look stronger. Money flowed in, credit expanded, confidence hardened. But the arithmetic underneath was already shifting. Because the moment reserves start thinning, the direction reverses. Loans still demand dollars. Investors begin pulling money out, and suddenly the shield must hold against both. This is where most currency collapses truly begin, not with panic, with pressure. Because before a currency breaks, it moves through a hidden sequence, 4 stages, 4 structural shifts that almost no one sees while they're happening, until the peg finally snaps. When people look back at currency crises, they usually blame one group: speculators. The story sounds simple. Traders attack the currency, panic spreads, and the system collapses. But that explanation misses something important. Speculators can only attack a currency after the structure underneath it has already weakened. Long before the collapse, the peg quietly changes behavior across the entire economy. When the exchange rate appears locked in place, risk seems to disappear. Companies borrow abroad because dollar loans look cheap. Banks expand credit because the currency feels stable. Investors send capital because the peg looks permanent. And slowly, the balance begins to tilt. Foreign debt rises. Short-term capital flows grow larger. More and more of the system begins depending on the same promise, that the exchange rate will not move. For years, nothing seems wrong. The peg still holds. The market still trusts it. But underneath that calm surface, the arithmetic is changing. Because the longer stability lasts, the more leverage the system quietly builds. And leverage has a habit of revealing itself all at once. Speculators don't create the collapse. They arrive when the structure is already under strain. They simply expose the math that was there all along. For long stretches of time, a currency peg can feel almost unbreakable. In Thailand's case, the baht held close to 25 per dollar for more than a decade. Businesses built entire pricing models around it. Importers ordered inventory months in advance, assuming the exchange rate would not move. Banks wrote loans in dollars because repayment looked predictable. Investors moved money into the country believing the peg was solid. Year after year, nothing dramatic happened. No sudden shocks, no visible cracks. Stability slowly hardened into belief. And belief is powerful inside financial systems. Once people trust a fixed exchange rate, they begin making bigger decisions around it. Companies borrow more, banks lend more, investors send more capital chasing growth. The entire system expands on the assumption that the anchor will never move. But this is where the quiet feedback loop begins. The stronger the peg appears, the more risk the system is willing to take beneath it. Foreign currency borrowing grows. Short-term capital flows increase. Balance sheets quietly fill with dollar obligations. None of this looks dangerous while the exchange rate holds steady. In fact, the system appears stronger than ever. But stability can be deceptive, because the peg is not removing risk, it is concentrating it. And the more the system leans on that single promise, the more fragile it becomes when pressure finally arrives. The pressure does not begin with a headline. It begins with hesitation. At first, investors simply slow down. New capital that once flowed easily into the country becomes more cautious. Some funds delay new projects, others quietly move money elsewhere. Nothing dramatic, just less money coming in. But the system built during the boom years still needs dollars. Companies must repay foreign loans. Banks must roll over short-term funding. Importers still need to pay suppliers overseas, and suddenly the central bank becomes the last line of defense. Every time dollars leave the country, the bank must replace them with reserves from its own vault. Day after day, the shield absorbs the pressure. On paper, the peg still holds. The exchange rate barely moves, but the cost of defending it is rising, and the clock has started. Because reserves do not drain in a straight line. The more markets suspect weakness, the faster money begins to move. Capital that once chased growth now moves toward safety. Meanwhile, the obligations remain. Loans still require dollars. Imports still require dollars. So the central bank keeps defending, selling reserves, buying time. But time inside a currency defense is not neutral. Every day the peg survives. The system behind it grows weaker. At this point, two forces that once strengthened the system begin moving against it. During the boom years, stability encouraged companies and banks to borrow heavily in dollars. Those loans made sense when the exchange rate looked fixed. Repayment felt predictable. Risk seemed distant. But now, capital is beginning to leave. Investors who once sent money into the country started pulling it back out. Some sense instability. Others simply follow the shift in momentum. Either way, dollars begin flowing the opposite direction. And both pressures land on the same place. The central bank. Companies still owe dollar debts. Banks still need foreign funding. Investors now want their capital returned. Three demands. One source. The reserves. This is where the math compresses. Because currency defenses are not tested gradually. They are tested at the moment when obligations exceed the buffer meant to absorb them. Confidence weakens quickly. Capital moves faster. And the shield protecting the peg begins to thin. Not slowly, all at once. Because once the arithmetic flips, stability stops being policy. It becomes a countdown. By early 1997, Thailand had deployed tens of billions of dollars trying to defend the baht. On paper, the country still appeared to have a powerful reserve shield. But much of that shield was already committed through forward contracts, promises to deliver dollars that had not yet left the vault, which meant the visible buffer was larger than the real one. The market didn't see the gap immediately, but the arithmetic was already broken. Currency pegs rarely collapse in the moment they look weakest. They collapse when the math underneath them quietly stops working. The peg was already broken. From the outside, Thailand still looked protected. Headlines pointed to large foreign reserves. The central bank appeared ready to defend the baht for as long as necessary. To most observers, the shield looked thick. But the number the public saw was not the number that mattered. Because reserves already promised in forward contracts cannot defend a currency twice. The official buffer suggested strength. The usable buffer was far smaller. And markets eventually noticed the difference. Not with a speech, not with an announcement, with capital leaving the system, quietly. Then all at once. Mechanisms like this rarely belong to a single country or a single crisis. Any system that promises stability, a fixed exchange rate, a permanent peg, an anchor that cannot move, begins to attract the same quiet pressures. Debt expands. Capital moves faster. The shield becomes the reserves. For a long time, the structure appears calm, until one simple question begins to matter. When the pressure returns, what is actually standing behind the shield? This is the pattern that tends to appear before a currency peg finally breaks. Stage 1. Artificial stability. Capital flows in. The exchange rate barely moves. Businesses, banks, and investors begin treating the peg as permanent. Stage 2. Hidden leverage. Foreign borrowing expands beneath the surface. More companies and banks begin relying on dollar funding that assumes the exchange rate will hold. Stage 3. Reserve drain. Confidence starts to wobble. Capital slows or reverses. The central bank quietly spends reserves defending the peg. Stage 4. Mathematical break point. External dollar obligations become larger than the reserves protecting the system. At that point, stability is no longer a policy. It is a countdown, not panic, arithmetic. And when the numbers stop working, the peg doesn't gradually weaken. It snaps. The lesson from crises like Thailand in 1997 is not that currencies suddenly fail. It's that stability often weakens long before anyone notices. At first, the system looks strong. The peg holds. Businesses keep borrowing. Capital continues flowing in. Confidence feels justified. Then reserves begin absorbing pressure. Then capital starts moving faster. Then the arithmetic quietly shifts. And by the time the currency finally breaks, the countdown has already finished. Because financial systems rarely collapse from surprise. They collapse from structure. Promises depend on shields. Shields depend on numbers. And when the numbers no longer hold, stability stops being a guarantee. It becomes a condition. If you understand structural pressure, comment below.